Hello and welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate pros in tax. I'm Tim LeMasters. In today's episode, we will dive into what makes a client truly qualified, not just on paper, but in terms of fit, readiness, and long-term potential. We'll break down some of the key industry-specific qualifications we look for, especially in specialized areas where compliance, documentation, or scale matters. Just as important as what qualifies a client, we'll also highlight a few red flags or disqualifiers that can derail an engagement before it ever starts. Understanding both sides of the qualification coin is critical to protecting any client's time and company. Joining us today on Let's Talk Tax is Tanner Niehaus. Welcome, Tanner.
Thanks for having me, Tim.
It's a pleasure, man. First time for you.
Yeah, it's good to see you in person. It's been
It
a little
is.
bit.
Yeah. So for those, our audience, Tanner works out of our Atlanta office, and obviously I'm out of our headquarters in Indianapolis. But I think a good place for us to start, Tanner, just give us a little bit of your background. Tell us kind of what you do here at McGuire Sponsel, and I would say internally and externally would be good.
Sure, absolutely. So, like I said, manage the R&D team out of our Atlanta office. Get involved in a lot of different areas, whether it's proposals and business development activities, sales support for you and your team. Audit defense is an area where I've had a lot of involvement over the years. And then obviously just taking on different projects, working with our team when we have those kind of interesting, unique, different challenges that come up with clients in CPA firms, whether it's qualifying a project up front or as we get into the details of something, unique situations that come up, things of that nature.
Sure. I think something that's really good to highlight is with your background, dealing with the R&D tax credit is one thing, but dealing with the IRS is a totally different thing. And what I think is good about our outline income, what we're going through today, to qualify a client, we focus on not only how the guidelines show it, kind of what's in the actual book itself, but also how the IRS views it. Because we know that we can obviously get our IRS agents, one's going to try to die on a sword with it or die on a hill. The other ones are going to kind of look at it and they're going to move through and say, okay, this qualifies, we're good to go. But let's maybe just highlight a couple key things with you working with the IRS. What are some of the key things that they focus on when they kind of come in and look at a study?
Yeah, so first and foremost is, do the projects qualify? Is the work that the taxpayer, the business is doing, does it meet that 4-part test? Do any of the exclusions apply? Have those been properly considered? First and foremost is, do we have qualifying R&D projects?
Yeah.
After that, then it's documentation, tying people to projects. What are the expenses associated with it? But from our perspective, every audit starts with, okay, can we agree that there is qualified R&D taking place? The projects that we have, said are qualified, we agree that they do. We can get into the details of tying expenses to those projects. To me, is a secondary concern. First and foremost is, hey, these projects qualify. Here's the proof.
Do you see state and federal agents being different?
From time to time, like you said, it's a coin flip with anybody to some degree.
Sure.
Whether it's with the IRS, whether it's a state Department of Revenue. We've had situations in the past where we've got agents who have been doing it for 15 to 20 years, and they know the credit, and we can work through really professionally and well with them.
Sure.
We've had other situations where we're working with an agent who is still in training and admits as much as we're working through that process. So to some degree, we're educating them about the qualifications and the different aspects of the credit, which is an interesting experience.
Yeah. Would you say that we tailor some of the training to what the IRS is looking at as far as any new hires or people that are coming in, starting the R&D practice? Is it something that you say, okay, this is the IRS guidelines. Obviously, we have agents that have come in and they talk differently about it. But then here's our guidelines and how we're going to merge the two together.
Absolutely. I mean, I think our deliverable that we put together has been refined over the years to meet those criteria that the IRS is looking for, or at least big picture. And so, yeah, that's a foundational piece of our training internally. But also I would say, when we're not necessarily training, but educating clients and working with our clients to say, hey, here's the type of documentation you have that's excellent. Moving forward, here's what we could do to make it even better, from whether it's expense tracking or, again, project documentation, all those different aspects. It's okay, hey, here's what you have that works, but here's what we can do to refine that and make it better moving forward.
That's great. Let's jump into kind of the fit of a client, potential client. What are some of the things that we're going to really focus on as we're having discussions? And obviously an upfront discussion is very, very important because there's a lot of ways the client can qualify. There's a ton of ways the client can disqualify. So let's talk about what a good fit is to look at claiming the R&D tax credit.
Yeah, again, first and foremost, it's, are they doing qualifying work? Let's look at the projects they're working on. So I think, Tim, your team does a great job of really vetting these projects up front and saying, hey, here's what type of industries make sense. Here's let's have a conversation with them to make sure they have a team that is doing R&D activities. So whether that's design work, engineering work, product development, process improvement, there's a number of different things that can qualify. But let's start with, you have a team, a business has a team that is consistently, regularly doing those types of activities. To me, that's kind of step one for a good opportunity.
Yeah, and moving into, obviously we can think of multiple ways certain industries can fit, but when we talk about the readiness of it, and we start focusing on, all right, yes, there's qualification here, but here's the things that we've got to get you ready for. Let's discuss that a little bit.
So curious your opinion, but to me, first and foremost is, is there somebody who is motivated to do this? Is there utilization available?
Sure.
Are they going to be able to derive benefit from the credit, whether immediately or in the near term? Is something that I think is required for buy-in.
Yeah, I think we're fortunate, though. We obviously work through a very large network of CPA firms. So we're very fortunate knowing if one of our relationships is bringing a client to the table, typically there's utilization. They need to figure out, hey, how can we save them tax money, right? So that's the first and foremost. So we get that side of it, and I think it would be a little bit more challenging going direct to market and having conversations with clients directly, get them excited about a credit, and then they're like, well, our CPA says we can't use it, so we're not going to do it. So wasting their time, wasting our time, and internally, it just doesn't make sense. So that part of it is where we really have some success in understanding that there is going to be something there for utilization, because we just need to find the qualifications. And looking at, we get a lot of time on the calls together. You mentioned that you support the sales team and kind of our conversations. Let's talk about how those calls look. Because when we get in those calls, a lot of times we're going to break down what those key sectors are of how they can qualify. A lot of entrepreneurs out there are going to immediately go, well, we do all this stuff. Everything qualifies. So I think it's good for us to kind of hone in and just discuss what are those key qualifiers. And you talked about the 4-part test. Obviously, we don't need to dig into that completely. But when we look at a client, and we'll get into a couple industry specifics here in a minute, but when you look at a potential client, those key things that we're going to dig for on those calls, let's start with kind of how we walk through those with people.
Yeah, so the first thing is, 3,000-foot view, 30,000-foot view of what is your business operations? Are there opportunities within your day-to-day operations that make sense for the R&D credit?
Yeah.
After that, it's, what is the team working on those types of things? Is it 2-3 people? Is it a larger team? Or is it maybe only one person doing it every once in a while? So having people who are regularly contributing to R&D effort, that's a mainstay of their job responsibilities, is where you really start to see a good opportunity. One of the things we often discuss is, hey, what's the ROI on this? Is the juice worth the squeeze of us going through the effort, of the business going through the effort to gather the documentation needed, to spend the time with us, and to do all those things? And that's
usually we say that's about what you'd say roughly $250,000 of qualified research expenditures. And we'll probably mention QREs a couple of times throughout this, so that's what that stands for. But the thing that we like to dig into is, once we figure out, okay, there is qualification here, and then the one thing that I find interesting is a lot of people don't realize that a few things. Customer-driven work qualifies. It doesn't have to be new to the world, right? They always think it's like, well, someone else may be making this. Well, okay, but is it new to your business? That's really what you need to focus on. And then the last thing I would say is everything from the conceptual design to when the product is commercialized, all that in between, okay, all that work is what we're looking at if identify the qualified research expenditures. And that to me is always an interesting thing, because you get on a call and people always think, well, we don't wear white lab coats, test tubes, and beakers. We're not messing around with that stuff. Okay, well, that's fine, but are you developing new products, new processes, new technologies? Are those things you're doing internally? Are you going to utilize it for some sort of business component? Is it something you plan to utilize internally, sell, or lease? If so, there's opportunity here. We just need to figure out where it's at.
Yeah, you mentioned earlier that a lot of times we have entrepreneurs who are like, everything we do qualifies. But we also get the other side of the spectrum, which is, like you said, hey, we do this every day. Other companies are out there doing this. And that's where you got to, from our side, understand the industry, and to be able to say, hey, here's what we commonly see in your line of business. Are you doing product development daily?
Yeah.
Are you getting customer requests that you're providing quotes for, and then you have to figure out how to successfully deliver on the back end?
Yep.
And those, hey, we've got a team of engineers who do that every single day. They don't necessarily realize it, but they're doing research and development every single day.
Sure. And, I'm going to bounce around here a little bit. We find out qualifications are there. What are a couple things that you would say we really have to identify outside the 4-part test to make sure that we're not kind of dead on arrival?
Yeah. So first and foremost is if it's client-driven work, you got to consider funded research. Okay. So do they have economic risk within the contract structure with their client? Typically, kind of rule of thumb is, hey, if it's a fixed fee contract, we're going to satisfy the funded research requirement, and that's something that would be eligible.
Okay.
So that's number one. Number two is typically the adaptation exclusion. So, hey, are you just taking something that you've already done in the past and making minor modifications? Maybe it's an aesthetic, it's a slight tweak. That's not going to qualify. However, we oftentimes see clients who are, to some degree adapting what they've done in the past, but it's a new function. It's a big efficiency improvement.
What I like to say, not sorry to interrupt you, but what I like to say is if you get kind of your upgrade on your phone and it goes from version 10.1 to 10.2 to 10.3, those probably aren't going to qualify. But version 10.3 to 11.1, that's the qualification we're looking for. There's some meat and potatoes to what they're doing instead of just your small tweaks. Would you agree to that?
Absolutely.
Yeah. I think it's always fun to be on those calls because you get to hear how inspired people are, by their business and the people within their business and all the drivers, movers, and shakers. But you have to kind of tone it down a little bit and say, all right, but there's some specific things we've got to figure out to make sure that you're not going to be in a disqualification situation, right?
Absolutely. And I think our team does a good job of, again, knowing the industries, knowing what type of work, both on our relationship manager side as well as, the R&D practice who's supporting that. And I think we know the right questions to ask when we get in those situations based upon the line of work and kind of how their operations are set up.
I would agree. And that's a good segue. Let's talk a couple industry specifics real quick. There's a couple industries that I believe can be a little bit more challenging. I would say it's something where they either have trouble figuring out that they're qualified in our discussions or they think they're a lot more qualified than what they may be. Let's talk about the tech industry. I think that's a really good space to be in because there's a lot of ways tech companies can qualify, but then there's so many ways I feel like that can disqualify them. So let's jump into that a little bit. Tell us a little about your experience with tech companies. I feel like you've had a ton, both on our side and with the IRS. So walk us through that a little bit.
So the big thing with tech companies is exactly what you just described. Is this a new project where we've got functional improvements, new features, efficiencies improvements, et cetera? Is it version 11.1 or is it 10.2 to 10.3 where we're doing maintenance and bug fixes?
Sure.
And many times in those tech companies, that's ongoing developmental efforts. So drawing the line between those two areas of ongoing development, maintenance, bug fixes versus, hey, this is a new step forward that's going to qualify for the R&D credit. Drawing the line between those two is something that takes a lot of time and care to work with their team on. Typically, when we get into it with those companies, they have very good, whether it's time tracking, sprint schedules, different type of project launches where we can say, okay, based upon the documentation you have, here's where a reasonable judgment would be to say this is a new qualifying project versus this is a minor update. But that's can be difficult to explain up front to somebody who say, well, we're doing development all the time.
I would agree. And let's talk about the companies because AI is always evolving. Let's talk about the companies that your manufacturing companies, your kind of your regular day-to-day companies that are jumping into some sort of software development. Let's separate a couple things here. Company calls and say, well, we're doing software development. Okay, well, what is it? Well, we built a website. Okay, well, let's talk about that. What did you do when you built the website? Who built it? Did you build that internally? Do you have developers internally that did that? Do you use somebody outside? Because building a website is kind of a gray area when it comes to the R&D tax credit. Can you touch on that just a little bit?
Yeah, so absolutely. If it's something where there are features that allow communication with a customer, client orders, things of that nature.
Yeah.
you've got potential there.
Client interaction.
Exactly.
Yeah.
If it's marketing, it's here's our presence, here's our location, et cetera. That's more going to be on the aesthetic side. There's not a ton of technical uncertainty in that type of endeavor. And the other thing we see a lot is, hey, we bought a software package that we're implementing. We're having to configure it. We're having to do different things with that. We've got a person who's dedicated to this integration. And there's a lot of gray area there as well, where people, frankly, are spending a lot of time and having challenges to work through.
Yeah.
But more often than not, if you're looking at an off-the-shelf type of package that you're implementing, it's not going to qualify.
We have to consistently explain, because this is the one thing that these entrepreneurs, and this is why they're entrepreneurs, they look at it as everything as far as business risk, marketing risk, all that they can throw into this qualified research bucket. Well, they have to be able to, in their mind, separate the business risk and marketing risk from technical risk, because technical risk is what we're focused on when it comes to the R&D tax credit, and that's the big challenge. And I think developing a website, there is risk. There's cost involved to that, and we get that. But there's just not that technical side. It's got to be rooted in the hard sciences. And even when they do those development cycles, and even if it's client engaging, if there's in some sort of interaction with the client, it's to them, it's like, well, the client goes to my website and they review things, and we develop that for the client facing. But is there a portal that they're going through? Are there some sort of challenges that you've had that you created this website to make it easier for your clients? That's the big thing we've got to be able to separate.
Absolutely. And I think our team does a really good job of being realistic with people. And one of the things that I have seen over the years that both our alliance partners and the businesses and the business people we deal with is, we're going to shoot them straight.
Yeah.
And we're not going to sugarcoat it. And, you may think you've got this opportunity, but realistically, it's a portion of that.
Yeah.
But understanding and being, I think, honest about that up front is something that people really appreciate and respect.
Yeah, I would agree. Well, let's jump to a different industry, and I think we can kind of hit two with one stone here. The first one that I think we can talk about is obviously government contracting, but we're going to mix bioscience into that as well. And I think it's a lot to do with the SBIR loans that they're getting. And there's always a little bit of confusion. And even on our end, when we try to explain it, especially when you deal with bioscience, because their brains aren't hearing it the way that we're saying it, and then they're saying it back to us, it's all the same, but we're just not understanding each other. And I think that's something that we can kind of discuss here. So let's talk about one. We obviously know that most government contracting and most bioscience is qualified. There's no doubt. But the challenge is with the SBIR loans. Talk about those a little bit and kind of what we need to find out to make sure the qualification sticks.
Yeah, both of those industries, you can check off the 4-part test very quickly. Everything they're doing is technical in nature. There's tons of challenges. They're having to work through it to make it happen. It all comes down to funded research. So, we've said it before, just because there is some sort of funding mechanism doesn't disqualify a taxpayer from claiming the R&D credit. What you really need to look at there is retention of IP or the research rights, and then also that economic risk factor. So typically with an SBIR, you're getting a set amount of money. The question is what's the deliverable? So do you have to successfully deliver a prototype? That's likely eligible.
Okay.
If you just have to prepare a report based upon your test results, that's unlikely to qualify.
Yeah.
A lot of times what we see is SBIR phase 1 is going to be non-qualified because it's going to be more of that kind of preliminary assessment type work. And then SBIR 2, 3, 4 maybe is where we get into, okay, we have to successfully develop something in order to close that funding.
So it's considered project by project. SBIRs we'll consider those projects. Because I look at it, I think architectural industries, construction industries, everything they do is not going to qualify, but there are project by projects that we look at and we kind of separate those. When it comes to the SBIR loans, how are you guys sifting through that to separate from phase 1 to phase 4? Because there could be something in phase 1 potentially. A lot of times, like you mentioned, there's not. But then we get into phase 2, maybe the back half of phase 1, whatever. How are you guys kind of internally sifting through all this to identify what we can move forward with and what we can't?
Well, obviously, first steps first is let's look at the language in the contract because handshake deals don't mean anything to the IRS. It's
Correct.
Really about what is the explicit language within that contract or agreement or whatever that document is. So that's step number 1. Mm-hmm. Once we're able to say, okay, phase one, non-qualified, phase two is qualified. We're looking at the activities that the employees are conducting, or anything that they're outsourcing, and saying, okay, this type of activity is preliminary assessment, report preparation, upfront testing, et cetera. And then we can shift and say, okay, well, this is actual prototype development. Sure. This is testing of that prototype to ensure that you successfully meet whatever specifications or requirements there are.
Yeah.
And that's the aspect we're going to qualify.
Okay.
Sometimes clients are tracking their time specifically to those different phases. Sometimes they're not. And so we have to look at the timeline of it. We have to look at the different activities that different employees are working with, and have those conversations with them.
Yeah, that's great. Now, so we're running short on time, but I want to touch on something that I think is very important. We obviously, the industries we talked about could be some, they could be some smaller companies, but we've focused on kind of our larger, multi-million-dollar, some billion-dollar companies. Let's talk about the startup phase real quick. And I think it's very important because a lot of startup companies qualify for the R&D tax credit. Let's talk about utilization for that. I think that's something that's missed a lot. Obviously, we know that there's a couple different ways that you can utilize the credits. Some of these startup companies are just not in a position that they're going to be able to offset tax because they just don't have any tax. But I think the key part is them knowing that they can utilize the credit to offset a portion of the payroll. And there's a small window to do that, right? The first 5 years, under $5 million in revenue, kind of that incubation stage is when they can utilize the credit to offset payroll. But there's a lot of startup companies that are missing that money. And as well as I do, startup monies are hard off for cash sometimes. So maybe just walk through how we look at startups and the importance of them looking to utilize the credit.
Yeah, you're absolutely right about that window and those qualifications. The other thing is that it has to be done on an originally filed return. Mm-hmm. So you can't, yes, we can go back and amend to claim credits, not to utilize as the payroll offset. But it's a great benefit. Companies are filing quarterly 941s. Mm-hmm. If you're able to file a return with an R&D credit utilizing the payroll offset for March 15th, you can claim that on your Q1 941 as a direct offset to the amount of employer side payroll taxes owed. So that's, you're talking about benefit within a month.
Sure.
At that point. And you continue to use it throughout the year until it's quote unquote used up. But that's immediate cash savings for a startup company that, to your point, doesn't necessarily have tax liability yet.
Yeah, I would say that the message to a lot of our CPA relationships, if they get a startup client, the first thing they should be talking about is the R&D tax credit and finding ways to save them money, because there's a lot of investment that goes into startups. So, but I think this was great, Tanner, and I really appreciate your time. And it's something that we could obviously spend probably another 45 minutes talking about this because there's so much into it. But I think we really hit on some of the key areas. Is there anything that you believe that maybe was missed today that you would like to kind of get out before we close?
I think to your last point there, let's have the conversation. We're happy to talk about it. And if you have a startup client or if you have a client who has an engineering function, let's have the conversation. We want to make sure that clients we work with, it's a mutually beneficial relationship there. Mm-hmm. And we're happy to invest the time to vet that and have that conversation to see what makes sense for everybody.
Tanner, I really appreciate it.
Thanks for having me, Tim.
Yeah, absolutely. Thank you for taking time to tune in today. You can subscribe to Let's Talk Tax Podcast on YouTube and follow us on Spotify or Apple Podcasts or whatever you listen. In addition, today's show notes and links to more about the episode can be found online at mcguiresponsel.com/Let's Talk Tax Podcast. We'll see you next time. Thanks, everyone.